And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. Okay. Quite a week we had this week. I mean, you think about it. We start out on Monday with an 800-point drop. Why? Well, they're upset about the 15% tariffs, and the news that came out across the wire, we're going to lose 10% of all our white-collar jobs because of AI. 800 points. But you wake up Tuesday morning, and we rally up 200 points. They're telling you, don't worry about the 15% tariffs, they're nothing. And we thought about it overnight, and losing 10% of our white-collar jobs, it's not going to be any big deal. So we rallied a couple hundred points. Today, they reaffirmed, hey, we're fine. You know, don't worry about the AI jobs anymore. Nobody's going to lose their job, and Trump's got everything under control, and he had an excellent speech last night, and everybody's all pumped up. So let's rally. Let's go in and buy on the dip. And by the way, because of that speech last night, consumer sentiment is back up. Yeah, now remember, this is noise. This is the noise that we get from the TV jibber jabbers. Are you nuts? These people, they always have to be optimistic. That's their job. They're not truth tellers. The truth teller, remember, are your yields, the 10-year Treasury yields, the spreads between your 10-year Treasury bond and the corporate bonds. That's the truth. That's where the truth serum is. This is all just fluff. That's their job, to make you feel good. So they're saying the consumer sentiment is back because AI, the panic, that's all gone now. It's all cooled off. And more Americans now are saying, God, there's plentiful jobs. We never knew that. And fewer are saying it's hard to find a job. There's so many of them. Again, you've got to follow the institutional money or you're going to be nuts. I mean, you've got to follow institutional money or you're going to listen to this crap. The institutional money tells you the truth. The 10-year Treasury yield tells you the truth. The corporate spreads tell you that the 10-year Treasury yield tells you the truth. Not these jibber jabbers on TV. Now, consumers are confidence. Confidence is up. Job perceptions improve, they're saying. Young households, young people, they're really optimistic now. They're really upbeat. Everything's great again. And and the institutional money sees something quite different. You always follow the institutional money, because remember, the institutional money is what drives the stock market. It's what drives the gaps up. You ever see a stock closed at 100 and next morning opens up at 1.25? Retail investors can't make that happen. Retail investors can't push the price of stocks. It doesn't work that way, okay? It's institutional money that drives the stock price. That's the first thing that moves, is price. Then the next thing you look at is your bars on your chart. See what's behind the price moving, and then you look at your momentum. Is the momentum still going up, pushing up, or is the momentum reversing and going against your rally? That's what you have to look at. Because many times you'll see stocks that are being pushed up by jibber jabbers, by buy on the dip, nonsense. You see stocks going up, and again, you don't have the momentum on your side, and then all of a sudden you're losing money again. So institutional money is what we have to watch, and they're saying something quite different. They see the economy as really slowing, and they see the big money. And remember, we say institutions. What are institutions? Institutions, there's 10 of them, okay? There's 10 institutions, and I'm not going to go through them all. There's a whole list of them. But there is one of the institutions, which is the Maverick, and that, of course, is your hedge funds. That's a Maverick. What do I mean by that? Well, what I mean by that is you always follow the money, you follow the institutions. So you go back to February 9th when the yield started to drop, right? That's because the hedge funds, one out of the 10 institutions, decided to buy bonds and to push the yield from 3.35 down to 3.95. Then when it got below 4%, there's a stable line right there. It's a stable line. And once it got through that stable line, it started, instead of buying bonds to pull that yield down, they started to sell bonds to push from 3.95 back up to that 4%. And the big institutional money decided to buy bonds, not to let it go up. So we're in this little space right now, this little area, this little space. And you're going to see volatility in this little space because the institutional money is controlling that bond yield. So as long as they can keep it at 4%, the message is everything is stable. So that's where we are going to be for a while. So what's happening today? You're getting a lot of people who are buying on the dip. You're getting short covering today. So that's why we got another little rally today. But the institutional money, it doesn't see it the way that the jibber jabbers see it. They see the stock market as really narrow, a real problem, okay? They see it as the institutions know that the rally is being carried only by a handful of stocks, and that's not good. It's being carried by the mega cap tech stocks, the AI infrastructure like Amazon and Microsoft, that just a handful of semis, NVIDIA, AVGO, Broadcom, and AMD. That's carrying the whole market. And then you've got the breadth is very weak. Very bad breadth in this market. So what's happening is that they're watching the yields, as I just mentioned a moment ago, more than earnings. So as long as you see that 10-year yield at that 4%, then everybody's taking a breath. The market's not going to crash right now. It's not going to really rally big. We're just at a standoff. That's where we are until a catalyst hits. Now, the catalyst that's going to hit, okay, is going to be that, and everybody makes the same mistake. Everybody looks at the S&P when they say, well, when's the market going to crash? Is the market going to crash? Everybody looks at the S&P as a signal for it to crash. The reason why everybody looks at the S&P as the signal that will tell us the market's going to crash is because the dopes on these financial TV shows lie about it. They point to S&P as the critical one that identifies when the market's going to crash. That's totally wrong, total lie. It's never been true. For years and years, the last 20 years, you look back, every time we've had a big correction or crash, it's always been the small, mid-cap stocks have led the market down. The small, mid-cap stocks, IWM, that's what you look at. That's the indicator. When IWM starts breaking that 50-day moving average, that's the first one that always breaks. That's the one that tells you we're going into a correction or a crash. Not the S&P, because remember, the S&P is a lagging indicator. You want to look at the best forward-looking indicator, and that's the small mid-cap stocks. And the problem, why they're such a good indicator, because they are very risky. Small mid-cap stocks are real risk. Why? Because they're small, and they depend on banks. And when banks start tightening their lending, they get hit first. And then what do institutions do? They always take their risk money out first. And then what happens when they pull all their money out of the small cap is the real risk. The second risk, of course, is this mid cap. But what do institutions do the minute there's some question? They'll yank their money right out of risk. That's when it'll go through that 50-day moving average. Then it breaks the 200-day, and you better know how to sell short, because you're going to make a ton of money selling short. Or unless you know how to do an inverse, okay? So, and we teach that all the time here at Phil's Gang. But they're watching the yields more than ever, because it's yields that are important, not earnings right now. Everybody tells you earnings. No, it's the yields. Like I just told you, they've been manipulating those yields from that 4.35, whatever it was in February, around February 9th, to where we are today at 4%. Remember, it dropped below that 3%, which would indicate a crash. They got it right up off of that. Who's they? The hedge funds, who were responsible for bringing the yield down by buying bonds, and then it was under 3.95, were responsible for pushing it back up to 4 by flipping and selling bonds, and then it got at 4, and then the institutional money, all the 9 other institutions came in, and they started to buy bonds to make sure it wouldn't go above 4%. So that's where we are. So the yields are what they're watching every day. Can they keep that yield above that 4%? Just hold it above 4%. Make sure it doesn't go down through to 3%. And the minute it goes down through to 3%, they're jumping in and trying to and buying to try to put, selling to try to push the yields back up. So they're hedging is what they're doing. So it's because if yields drift lower and lower, that means risk. That's why they're holding that 4%. Because if yields keep drifting below that 4%, that's a lot of risk. If yields spike, then what happens is they pull back fast. Okay, so if yields start going the other way, then the institutional money just starts pulling back, and so yields. Right now, the yields are stable enough to keep everybody in the game. So you're going to start seeing a mix of stock buybacks. You're going to see, buy on the dips. You're going to see a whole bunch of crazy stuff going on. But so the market's in kind of a funny place right now, and that's why you'll see a lot of shifting going on. Now, they believe that AI spending is going to be real. But they know, too, I'm talking about big institutional money, they're smart. They know it's overhyped. They know it's the jibber jabbers on TV, on Fox and the rest are all hyping this AI crap. And they see this AI as just, again, a place you go to buy every time it's on the dips. You buy AMD every time it goes down. You buy Microsoft every time. So you got these same stocks that everybody buys when they go down. So we don't have this strong, broad market. We just don't have that right now. So they know that when they say the consumers are strong, they know that's a lie. They're weakening. They're not strong, not collapsing. But they're out of money. They have a lot of debt. Delinquencies are going up. Discretionary spending is what you need, where people go buy big screen TVs and appliances and big stuff. They're not spending on discretionary. They're spending on what they need. Their credit card balances are too high. So what you're hearing from Fox, CNBC, CNN, all these financial shows is total crap, okay? The yields will tell you the truth. That's where the truth is. The yields are always the truth. And you watch the yields, you'll always know which way the market's going to go. And then you watch that as they say, that 50-day moving average. If IWM breaks through that, learn how to sell short. So the market is not what it seems to be. See you on the charts. Join my gang. Free for 10 days.
Are you nuts?